Stop what you're doing. Seriously, if you own semiconductor stocks right now, you might be walking blindfolded into a massive trap. I know it's incredibly terrifying for retail investors to watch a powerhouse stock tumble from its highs for seemingly no logical reason. Last week, we ran ASML, arguably the most important tech company on Earth, through the underlying financial data, the competitive landscape, and some seriously threatening geopolitical legislation. And honestly, what we found shocked us. We're looking at a business that just did the absolute impossible. I mean, they shattered every major earnings benchmark, yet the market fiercely punished them for it. By the end of this explainer, you'll know exactly why this stock tanked and whether the underlying valuation models show it as a screaming buy you should scoop up or a dangerous value trap you need to avoid. Let's just dive right into this mind-blowing number. ASML just absolutely crushed their Q1 2026 expectations. We are talking 8.8 billion euros in net sales. 8.8 billion. To put that into perspective, that's a level of cash flow most companies couldn't dream of in a decade. But wait, they didn't stop there. They hiked their full-year guidance up to a staggering 40 billion euros. And they bumped their dividend by a massive 17%. It's the exact definition of a compounding machine, just firing on all cylinders. So here is the million-dollar question we have to ask. With all these record-breaking beats, wildly expanding margins, and massive shareholder returns, why on earth did the stock briefly touch a high of $1,547, only to violently reverse and drop? It makes absolutely zero sense on paper. And that is the exact paradox we are solving today. Moving into Section 1, the earnings paradox. To really understand this massive drop, we first have to wrap our heads around the sheer gravity of what ASML actually does, and just how incredibly strong the underlying business is operating right now. Just look at the scale of these numbers. A 53% gross margin on that 8.8 billion euros in revenue, that brings almost 2.8 billion straight to the bottom line. And get this, they have a backlog sitting at 38.8 billion euros. It's like looking at a financial fortress. This is compounding growth on full display, heavily driven by the whole AI gold rush where global chip capacity is literally struggling to keep up with demand. Section 2, the EUV monopoly machine. Now, in any gold rush, the absolute safest bet is the company selling the picks and shovels. And ASML, they aren't just a regular tech company. They are the ultimate pick and shovel play for the artificial intelligence era. And the kicker? No one else on the entire planet makes these specific shovels. Their secret weapon is EUV, or extreme ultraviolet lithography. ASML holds an absolute, undisputed global monopoly on this mind-bending technology. Basically, it uses light to print microscopic, atomic-level circuit patterns onto silicon wafers. So if industry titans, think TSMC, Samsung, or Intel, if they want to manufacture the world's most advanced AI chips, they have absolutely no choice but to buy from ASML. There is literally no alternative phone number for them to call. And this brilliantly illustrates why their margins are so incredibly durable. See, they don't just sell you a machine for hundreds of millions of dollars and walk away. Nope. Every single system requires ongoing calibration, software updates, spare parts, and field support. This installed base management brought in nearly 2.5 billion euros in Q1 alone. That's roughly 23% of their total revenue. It creates one of the most reliable, sticky, recurring revenue streams in the entire tech sector. Which brings us to Section 3, the Match Act threat. Okay, so we have an undisputed monopoly with booming revenues, incredibly high margins, and zero competition. Sounds perfect, right? Well, enter the antagonist of our story, impending geopolitical legislation that has the market completely spooked. Let's look at how this tension builds geographically. In 2025, a massive 33% of ASML's total revenue came from one single region, China. This flowed primarily through the sales of their older generation DUV, or deep ultraviolet machines, since the newer EUV tech is already heavily restricted. So a full third of their entire business relies on this specific flow of capital. Enter the Match Act. Now, as neutral observers of the market, our job isn't to take any sort of political stance here. We just need to purely analyze the financial impact of this legislation. The Match Act is a bipartisan U.S. bill that explicitly names ASML, aiming to entirely ban the export of those older DUV machines to China. But it goes even further than that. It also threatens to cut off the servicing revenue for the equipment that is already installed over there. You know, investors hate one thing more than anything else: uncertainty. China was 33% of revenue in 2025. Going into 2026, ASML actually guided that down to 20% as the cyclical pre-buying slowed down. But with this Match Act introduced in April, that 20% is suddenly at severe risk. Right now, there is a 150-day diplomatic window for the Netherlands and Japan to act before the U.S. might move unilaterally. That is a massive, massive chunk of top-line revenue just hanging in the balance. Section 4. The semiconductor equipment landscape. To truly understand if ASML's stock is currently overvalued because of this risk, or if it's fairly priced, we need to zoom out for a second and look at their peers. When you lay the numbers out side by side, the contrast is clear. You have Applied Materials acting as the broad, one-stop shop for manufacturers. You have KLA dominating process diagnostics with an incredible 61% gross margin. And Lam Research pulls in a massive 43% of its revenue just from services alone. But ASML sits on the absolute throne, with $33 billion in revenue and stellar 51 to 53% margins driven entirely by its lithography monopoly. Visually, you can really see ASML's sheer dominance in scale here. They generate billions more than their closest competitor, cementing exactly why they have been the fastest-growing company in this space over the past decade. They aren't just a participant in the semiconductor market. They are literally the bottleneck. Moving to Section 5. The valuation dilemma. This brings us to the ultimate conflict of this entire explainer. How do we weigh their immense financial firepower against this very real geopolitical risk? It all comes down to this one number, 48x. That is ASML's trailing price-to-earnings ratio. Make no mistake, this is a premium valuation multiple. When a stock is priced at 48 times its earnings, the market is demanding absolute, flawless perfection in execution. There is zero room for error and certainly no room for losing a massive geographical market. But, the bull case for that 48x multiple is aggressively strong. I mean, ASML is expanding its operating margins toward 40%. They're right in the middle of a massive 12 billion euro share buyback program. They already scooped up 1.1 billion in Q1 alone. And they just raised their dividend to 750 euros per share. Based on historical premiums, the ticker valuation model target price actually sits around $2,240, implying massive upside if they can navigate this geopolitical storm. So we can clearly see the tension mapped out right here. For the bulls, the AI capital expenditure cycle needs to continue. EUV demand must keep compounding. And critically, the Match Act needs to either stall in Congress or be severely watered down. But for the bears, if the Match Act passes in full, completely cutting off DUV exports and lucrative servicing to China, or if AI spending just takes a breather, that 48x multiple is going to compress rapidly, dragging the stock price right down with it. I absolutely love this quote from the ticker analysis because it just perfectly summarizes the tightrope investors are walking right now. As you digest all the data we've explored today, the takeaway is pretty clear. The long-term fundamentals of this business remain incredibly strong because of their monopoly, but the short-term geopolitical headwinds, those require an iron stomach. So, I'll leave you to ponder this final question as we wrap up. Does the premium of holding an absolute, globally irreplaceable tech monopoly outweigh the geopolitical reality of potentially losing access to a third of your buyers? It is a fascinating clash between perfect business fundamentals and a fragmented global map. Thanks so much for joining me on this explainer. Keep a very close eye on that 15-day window, and I'll see you next time.